In the grand, chaotic theater of 19th century Wall Street, the leading roles were played by two distinct types of men. First, there was the empire builder, the visionary industrialist like Cornelius Vanderbilt, who used capital as a tool to forge physical empires of steam and steel. Second, there was the speculator, the daring market operator like Jay Gould or Jesse Livermore, who used capital as a weapon to bet on the volatile psychological tides of price. These men, with their bold risks and epic battles, captured the public imagination and defined the era. But there was a third, quieter and perhaps more powerful archetype on this stage, the financier. And in the Gilded Age, one man stood as the undisputed master of this domain, Russell Sage. Sage was not a builder of railroads, nor was he a gambler on their future. He was the man who financed them all. He was the ultimate opportunist, the great risk manager, a man who looked at the roaring casino of Wall Street and chose not to play any of the games but to be the house itself. His method was not to predict the market, it was to fund it. He built one of the greatest fortunes of the era by simply lending money to the speculators, the industrialists, and the dreamers, always at a high rate of interest and always secured by their own assets. He was a paradox, a man of immense, almost unimaginable wealth who lived the life of a pauper, and a man who wielded enormous power from a position of almost absolute risk aversion. His life and career are a profound and timeless masterclass in a different kind of financial genius. The genius of capital preservation, of exploiting the needs of others, and of building an unbreakable financial fortress. So, what were the 8 fundamental pillars of his method? What were the principles that allowed the man they called the Sage of Wall Street to become one of the richest people in America by almost never speculating at all? Before we continue, let's take a moment. If you're finding this deep dive valuable, please subscribe to the channel and leave a quick comment. It helps us create more content like this and tells the algorithm that these historical analyses are worth showing to more people. To understand the 8 pillars of Russell Sage's method, you must first understand the man who built it. His entire financial philosophy was a direct extension of his character, a character forged in hardship, discipline, and an almost pathological aversion to waste. He was born in 1816 in a covered wagon, a humble beginning that instilled in him a lifelong appreciation for the value of a dollar. He began his working life as an errand boy in his brother's grocery store in Troy, New York. It was there that he learned the foundational lessons of business. Buy low, sell high, watch your expenses with an eagle eye, and understand that every penny counts. He was a natural businessman, expanding his family's small grocery into a major wholesale operation and branching out into other ventures, all before making his way into politics and serving as a U.S. congressman. When he finally moved to New York City in 1863 to focus on finance, he was not a young man seeking his fortune. He was already a wealthy and established figure in his late 40s. He came to Wall Street not to gamble, but to apply the same hard-nosed, frugal, and risk-averse principles he had learned as a young grocer, but on a scale the world had never seen. This brings us to the first and most foundational pillar of his entire method. Pillar number 1. Extreme frugality is the engine of capital. Russell Sage's personal stinginess is the stuff of legend. He was one of the richest men in the world, yet he was famous for his worn-out, threadbare suits for conducting business in unheated offices to save on coal, and for the oft-repeated story that his lunch consisted of nothing more than a single apple and a piece of gingerbread. He would argue with street vendors over the price of an apple and was known to berate clerks for using too many sheets of paper. To the outside world, this was the comical eccentricity of a rich miser. But for Sage, it was a deadly serious strategic imperative. He understood a simple, powerful truth. Every single dollar that was not spent on a frivolous expense was another dollar that could be added to his capital. And capital was his product, his inventory, and his only weapon. His extreme frugality was not a personality quirk. It was the primary engine of his capital accumulation. While his contemporaries like Jay Gould and Jim Fisk were spending their fortunes on yachts, mansions, and opera houses, Sage was plowing every cent of his earnings back into his central pool of lendable cash. This relentless, lifelong focus on minimizing outgoings to maximize capital gave him a constantly growing advantage over his more profligate peers. In a game where the person with the most cash often wins, Sage ensured he always had the most cash. This discipline of capital accumulation was in service of his second and most central philosophical pillar. Pillar number 2, avoid speculation at all costs. Be the casino, not the gambler. Russell Sage held speculators in utter contempt. He viewed the traders, the pool operators, and the public who bet on the market's daily fluctuations as irrational, emotional gamblers destined for eventual ruin. He had absolutely no interest in joining their game. He never tried to predict if a stock would go up or down. He famously claimed to have no opinion on the market whatsoever. His genius was in realizing that while predicting the outcome of the game was difficult and risky, it was far easier and safer to profit from the game itself. His entire career was an exercise in building a business model that made him the house. Think of a casino. The owner does not care if one player at the blackjack table wins a big hand, because they know that the statistical edge of the game over thousands of hands and thousands of players guarantees that the house will always come out ahead. The casino profits from the activity, from the sheer volume of bets being placed, not from the outcome of any single bet. This was exactly Russell Sage's approach to Wall Street. He wasn't betting on the game. He was providing the chips. He made his fortune by lending money to the speculators, taking a guaranteed high-interest cut from their activity, while they were the ones taking all the directional risk. He was dealing in a world of quantifiable risk, not unknowable uncertainty. Speculators grapple with uncertainty. What will the future price of this stock be? Sage dealt with a different and far more manageable problem. What is the statistical probability that this borrower will default on a loan that is fully secured by collateral? By focusing on the latter, he transformed the wild gamble of Wall Street into a predictable high-yield banking operation. This leads us to the mechanical heart of his empire, the third and most active pillar of his method. Pillar number 3, master the secured loan, the engine of profit. The engine of Russell Sage's profit machine was a specific type of financial instrument known as call money. The call money market was the high-octane fuel for the speculative frenzies of the Gilded Age, and Sage quickly became its undisputed king. The mechanics were simple but brutal. Speculators and stockbrokers needed vast amounts of short-term capital to finance their trades, especially when buying stocks on margin. Sage, with his immense and ever-growing pool of cash, was their primary source. He would provide them with loans, often on an overnight basis. These loans had two critical features that made them incredibly safe and profitable for him. First, as the name implies, the loan could be called in by Sage at any time for any reason. He could demand immediate repayment, forcing the borrower to either produce the cash or liquidate their stock positions to cover the loan. This gave him immense power and flexibility. Second, and most importantly, every single loan was fully secured by stock certificates as collateral. The market value of these stocks was always significantly higher than the amount of the loan, creating a massive margin of safety for Sage. If a borrower could not repay the loan, Sage did not have to chase them down in court. He simply took possession of their collateralized stock and sold it on the open market to recoup his principal and interest. The true genius of this model was in the interest rates. The rates on call money were not fixed. They were variable, fluctuating based on the daily demand for capital on Wall Street. During normal times, the rates were high, but during times of market stress or panic, when credit dried up and speculators were desperate for cash to meet their margin calls, the rates would skyrocket to astronomical levels. It was not unheard of for call money rates to exceed 100% on an annualized basis during a panic. In these moments of maximum fear, when everyone else was losing their fortunes, Russell Sage was at his most profitable. He was the calm center of the storm, the man with the one commodity everyone desperately needed, cash, and he could charge almost anything he wanted for it. He had created the perfect business model, a high-yield lending operation where the principal was almost perfectly secured and where the profits exploded during the very market crises that destroyed everyone else. Having established a philosophy of extreme capital accumulation and a strategic position as the market's banker rather than its gambler, Russell Sage needed a set of tactical rules for deploying that capital. The next three pillars of his method are not about how to build a fortress of cash, but how to use that fortress to project power and generate profits with an almost unnerving level of safety. These are the weapons of a true financier, designed to thrive in the very chaos that destroyed everyone else. Pillar number 4, capital is king, the power of liquidity. To truly understand the genius of Russell Sage's operation, one must first understand the nature of a 19th century financial panic. In the modern era, central banks like the Federal Reserve can inject liquidity into the system to prevent a total credit collapse. In Sage's time, no such safety net existed. A panic was a literal and terrifying evaporation of money. Credit, the lifeblood of the market, would vanish in an instant. Banks would stop lending to each other and to their customers. Brokers, unable to secure financing, would be forced to call in their margins, triggering waves of forced selling. In these moments, cash was not just a valuable asset, it was the only asset that mattered. And no one, not even the largest banks, had more of it readily available than Russell Sage. His lifelong obsessive frugality and his relentless compounding of interest had created a personal treasury so vast that he could, and often did, act as a private lender of last resort for the entirety of Wall Street. This was the strategic brilliance of his massive cash reserves. While other firms and financiers were leveraged and exposed, desperately scrambling for cash to survive, Sage was the calm eye of the storm. He was the man sitting on the one commodity everyone on Earth desperately needed. This position gave him two things that are the dream of any capitalist: immense power and near-total pricing control. When the call money market seized up during a panic, like the panics of 1873, 1884, or 1893, speculators and brokers facing ruin would form a literal line outside his office. They needed cash immediately to avoid being wiped out, and he was the only source. On a normal day, the interest rate on call money might be a profitable 5 or 6%. But on a day of panic, Sage could name his price. The rates would explode to 25, 50, or, in some legendary cases, an annualized rate of over 100%. He was selling water in the desert, and he charged accordingly. Furthermore, his power extended to the quality of the assets he would accept. In a normal market, he might have to accept a wide range of stocks as collateral. But in a panic, the desperate borrowers were forced to pledge their highest quality, most liquid assets, the blue chips of their day, to secure a loan. So at the very moment of maximum market risk, Sage's operation became safer. He was lending at higher rates against better collateral to more desperate borrowers. It was a perfect storm of profitability, made possible by the fourth and most powerful pillar: capital is king. Pillar number 5, collateral is non-negotiable. If liquidity was his strategic weapon, his tactical defense was an unwavering, fanatical obsession with security. This is the 5th pillar of his method. Collateral is absolute and non-negotiable. Russell Sage never, under any circumstances, made an unsecured loan. His mindset here was not that of an investor, but of a master pawnbroker. An investor analyzes a company and makes a judgment about its future. A pawnbroker does not care about the story behind the diamond ring a customer brings in. They care only about its immediate, objective, and liquid market value. This was precisely how Sage viewed the stocks and bonds that were pledged to him as collateral. He had no opinion on whether the New York Central Railroad would outperform the Erie in the coming year. He did not care about a company's management, its earnings, or its growth prospects. His calculation was brutally, beautifully simple. Is the current, easily verifiable market value of this stock certificate significantly greater than the amount of money I'm about to lend? His process was ruthlessly conservative. He would typically lend only a fraction of the collateral's market value, often 60 or 70 cents on the dollar. This created an enormous margin of safety. Let's analyze the mechanics of this defense. If he lent $60, secured by $100 worth of a volatile railroad stock, he had built a 40% buffer against loss. If the stock's price went up, he was indifferent. He simply collected his principal and his high rate of interest upon the loan's repayment. If the stock's price went down by 10% or 20% or even 30%, he was still completely protected. His loan was still fully collateralized. Only in the event of a truly catastrophic, near instantaneous collapse would his principal ever be at risk. And even in those rare cases, the terms of his call money loans gave him the ultimate power, the right to call the loan at a moment's notice, demanding either immediate repayment or the pledging of more collateral to maintain his safety margin. Failure by the borrower to meet this call resulted in the immediate seizure and liquidation of their stock. He had created a system that was, for all practical purposes, immune to the normal and even the severe fluctuations of the market. He had successfully eliminated the directional risk that plagued every other speculator on Wall Street. Pillar number 6, exploit fear and desperation. All of Sage's financial mechanics were amplified by a singular, powerful psychological advantage. While the rest of Wall Street was a tempest of human emotion, swinging violently from the greed of a bull market to the terror of a panic, Russell Sage remained a creature of pure, cold, reptilian logic. This was the 6th pillar of his method. Exploit the fear and desperation of others by remaining completely rational yourself. His miserly nature was a key component of this. His personal fear of losing a single dollar was always, on any given day, greater than his desire to make 1,000,000 more. This psychological makeup made him immune to the temptations of greed. He never got caught up in a speculative bubble because his aversion to paying a high price for anything was too deeply ingrained in his character. And in a crisis, his lack of emotional entanglement gave him an almost supernatural advantage. When the market was in a state of freefall, when his contemporaries were staring at the ticker tape in a state of paralyzed terror, Sage was at his sharpest. He saw not chaos but opportunity. He saw not ruin but a line of desperate customers at his door. His pulse did not quicken. His mind did not race. He simply saw the numbers. The demand for cash was high, the supply was low, and therefore the price, the interest rate, would be whatever he decided it should be. No event in his life illustrates this cold-blooded instinct for self-preservation more starkly than the infamous assassination attempt of 1891. A man named Henry Norcross, who had been financially ruined, entered Sage's office demanding an immediate payment of $1.2 million. Sage calmly refused and began to stall. As Norcross grew more agitated, he opened his satchel to reveal a lit stick of dynamite. In that split second of terror, Sage's instinct was not for heroism, but for survival at any cost. According to the sworn testimony of the man standing next to him, a clerk named William Laidlaw, Sage grabbed Laidlaw by the shoulder and maneuvered him between himself and the bomber. A moment later, the dynamite exploded. The blast killed Norcross, permanently disabled Laidlaw, and tore Sage's office to shreds. But Russell Sage himself, shielded by the body of his clerk, survived with relatively minor injuries. The most telling detail of the entire affair is what happened next. Covered in dust and debris just minutes after the explosion that should have killed him, Sage calmly returned to his desk and completed a pending financial transaction before receiving medical attention. This shocking story, while horrifying, is a perfect and brutal metaphor for his entire financial philosophy. It reveals a character forged from an almost inhuman focus on self-preservation above all else. Just as he was willing to sacrifice an employee to save his own life, His financial strategy was built on sacrificing any and all potential for speculative upside in exchange for the absolute, impregnable security of his principal. His method was one of ultimate survivalism, a system designed to be the last man standing after any explosion, financial or otherwise. This utter lack of panic, this cold-blooded rationality in the face of mortal danger, was the same trait that made him the perfect and most ruthless predator in a market driven by fear. With a fortress of capital built and an arsenal of defensive tactics perfected, Russell Sage entered the final phase of his career. It was in this period that he deployed the last of his great pillars, principles that governed his strategic interactions with the world and defined his ultimate purpose. These are the rules of the endgame, the principles that allowed him to not only preserve his empire, but to compound it to an almost unimaginable scale. Pillar number 7, partner strategically, trust no one. In the chaotic world of the Gilded Age, alliances were critical, but for a man as risk-averse as Russell Sage, a conventional partnership was an unacceptable liability. This led to his 7th pillar, a principle he demonstrated most brilliantly in his long and profitable association with the most feared speculator of the era, Jay Gould. Gould was a visionary predator, a master of complex corporate warfare and audacious market manipulation. He was a man of grand, high-risk schemes who was in constant need of capital to fund his campaigns. Russell Sage, the man with the largest and most liquid pool of private capital on Wall Street, was the natural choice to be his financier. For decades, the two men were the closest of associates, yet they were never truly partners. Theirs was a deeply cynical but perfectly symbiotic relationship. Gould was the brilliant, reckless artist of the deal. Sage was the cold, dispassionate banker who underwrote the performance, but only on his own ironclad terms. Sage's method for financing Gould's ventures is a masterclass in risk-insulated partnership. He never took an equity stake in Gould's speculative schemes. He never became a co-conspirator. Instead, he would provide a simple, brutally effective secured loan. When Gould needed millions to raid a railroad or corner a stock, Sage would provide the cash. But in return, he would demand that the loan be fully collateralized by a block of high-quality liquid stocks and bonds from Gould's own personal portfolio. Crucially, the market value of this collateral always far exceeded the amount of the loan. The genius of this structure was its indifference to success. If Gould's audacious scheme succeeded, Sage got his principal back plus his contractually obligated high rate of interest. He made a handsome, low-risk profit. If Gould's scheme failed spectacularly and Gould himself was ruined, Sage was still protected. He would simply seize the collateral he held, sell it on the open market, and recoup his principal and interest. He had structured the deals to be a near-perfect heads-I-win, tails-you-lose proposition. He was able to profit from Gould's genius and ambition without ever exposing himself to the immense risks that came with it. It was the ultimate lesson in strategic partnership. Work with geniuses, but never ever trust them with your own capital. Pillar number 8. Compound relentlessly. This is the final and overarching pillar, the ultimate purpose for which all the other pillars existed. Russell Sage's single, driving, lifelong objective was the pure, abstract, and machine-like compounding of his capital. For him, there was no enough. The fortune he was building was not a means to an end, it was the end in itself. He had no desire for a lavish lifestyle, no ambition to build a physical empire of railroads like Vanderbilt, and no interest in public acclaim. His entire life was an exercise in maximizing the input for his financial machine. His extreme frugality was the engine that created the initial fuel. His secured lending business was the process that generated the high-yield returns, and this final pillar, relentless compounding, was the prime directive to pour every single dollar of profit, every cent of interest, every dividend, right back into the machine's core capital pool. This explains the great paradox of his life. Even as he became one of the richest men in the world, his habits never changed. He continued to wear his worn-out clothes, to eat his Spartan lunch, and to count every penny because every penny saved was another soldier sent to the front lines of his compounding army. For Russell Sage, the process of accumulation was the entire point of the game. The machine had to keep running, faster and more efficiently, until the day he died. At the time of his death in 1906, Russell Sage's relentless compounding machine had produced a fortune estimated to be between $70 and $100 million. In today's terms, this would be a multi-billion-dollar empire, a staggering testament to the power of his 8 pillars. And then came the great, final, ironic twist of his life. He, the ultimate miser who had spent 90 years accumulating every possible dollar and had shown little interest in public good, left his entire vast fortune to his widow, Margaret Olivia Slocum Sage. He left no grand instructions, no dynastic vision, and no plan for its use. And so Margaret, finally free from her husband's pathological frugality, embarked on one of the greatest and most intelligent philanthropic campaigns in American history. She did not simply give the money away. She applied a level of strategic rigor that her husband would have admired. She gave away tens of millions of dollars to universities, including Cornell and Syracuse, to schools, to museums, and to a host of social causes, particularly the advancement of women's education. Her crowning achievement was the establishment of the Russell Sage Foundation in 1907 with a $10 million endowment. Its mission was the improvement of social and living conditions in the United States, and it remains one of America's most respected and influential foundations to this day, funding critical research in the social sciences. This is the final, profound paradox of Russell Sage. The man who cared for almost nothing but the private accumulation of money inadvertently enabled a legacy of immense and enduring public good. His extreme, lifelong personal vice was transformed through the wisdom of his wife into a great and lasting public virtue. The 8 pillars of the Russell Sage method, when viewed together, form a complete and timeless blueprint for the creation and preservation of low-risk wealth. His life was a masterclass in how to be the financial house, the calm center of the storm, profiting from the risks, the fears, and the ambitions of the gamblers who played the game of the market. He was the architect of the ultimate financial fortress, a man who proved that sometimes the surest path to victory is to refuse to play the speculative game at all. The world of financial markets is vast, and there is no single path to mastery. Today we've dissected the strategy of the banker of Wall Street, Russell Sage. But don't forget the other great schools of thought. The art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links to the channels for their in-depth study can be found in the description of this video.